Peter Schiff, Gary Kaltbaum, Pat Dorsey, and Bob O'Brien. Phil, first, we've got to start with you because in the aftermarket session, I'm just looking here, oil is moving higher by about $2.09. What's the latest that you're hearing from the pits?
Well, the latest in the pit that they're very concerned about this storm, and it's almost amazing that we're not even up more. And I think that's the biggest thing most traders are surprised about. I think they're kind of waiting until the last minute to make their bets and place it right ahead of the weekend. But right now, you have to wonder if this market would be higher if it weren't for the storm. It shows you how much the psychology in this market has changed in just a few weeks.
You know, Peter, Phil makes a good point. The psychology of the markets. In other words, yes, a quarter of the U.S. production of oil is in the Gulf, but it's really, I think, you know, when you look at it, the markets need to rally absent a government backstop, absent oil dropping. What else can move the markets higher besides those two issues?
Probably stupidity. I mean, I don't know anybody who's buying this market is not, doesn't understand the fundamentals, and apart from the oil, if you want to look at the real impact of any potential hurricanes, we don't have any savings to pay for this stuff. So when a hurricane comes through and destroys property, where do we get the money to rebuild it? We have to go deeper into debt. We got to go back to the Saudis and back to the Chinese and borrow even more money. The last thing our economy needs is a natural disaster.
Pat Dorsey, we did get this durable goods number that everybody's talking about as a sign that the economy is doing better than everybody thought, yet I'm just wondering if this isn't a blip on the radar screen. I'd love to see it be a trend as well. However, we're seeing companies hunkering down. They're not doing major cap expenditures, and they're also not hiring that much.
Yeah, I mean, the data is very, very conflicting right now in terms of we get this durable goods number, then we get some bad employment numbers, and the anecdotal evidence on the ground suggests that things really have not sustainably turned for the better. And I think, as with most things right now, it all goes back to the housing market. And until those inventories of existing homes come down and people start seeing a little bit of stability in their home prices, you get that negative wealth effect reversing itself. I don't think we can have a real sustainable rebound in the economy.
But Bob, what Phil is talking about right now, what's going on with Tropical Storm Gustav, there's a 50-50 chance it could be upgraded. How much of this is really, I mean, isn't there always a bull run in hurricane seasons in oil? And it's really could be more of a dollar and demand story?
Yeah, it could be. It's kind of fascinating, though, to finally watch oil, the prices being dictated by that plain old thing. The old saying among oil traders used to be, if you want me to tell you the direction of oil prices, tell me what the weather's going to be like. So it's kind of interesting to see it trading once again on basic fundamentals rather than on whatever drove it from $75 to close to $150. But yeah, you're right. Seasonally, there is this bull move. We're moving towards September, typically the heart of hurricane season. People start discounting the expectation that there is going to be some supply disruption, and that could be taking place. I think Phil makes a good point that it's perhaps a little surprising that we haven't seen a more dramatic reaction here.
Gary Kaltbaum, let's bring it back to the markets overall, and we did have a pretty decent rally today, but Peter Schiff would say that's there's not real foundation built under it that would last.
Well, look at the volume right now. There isn't any. Everybody's on vacation. Today's volume was less than July 2nd, which was a half day in the market. So you just got to keep that in mind. So they're just flipping things around here and there. The major trend remains down. I'm really not seeing, and I need to see powerful action to get me real bullish. There's really not a lot of leadership, nothing busting out to new highs on heavy volume. And I just think, we see these durable good numbers, but it's kind of a volatile number. And I think there was an inflation component that made it look better. I'm not seeing much great in the economy, so I think this is going to take a little bit more time.
So, Gary, just a follow-up quickly, what will make the markets break out? The markets need to rally. Absent a government backstop to Fannie Mae, Freddie Mac, absent oil, going down, what can make the market break out absent those two factors?
There is one word that markets always come back to, and that's earnings and the direction of earnings. And earnings are not very powerful right now. You can start with the financials, but retail earnings are pretty flattish to down. Until that changes, markets are going nowhere. Matter of fact, until the market starts picking up that changes, markets are going nowhere. You need growing earnings, and right now earnings are stagnant to going south.
Yeah, and they're going to go a lot lower. Pat brought up housing, looking for some stability in home prices. We're nowhere near there. Remember, nationally, we still have at least another 15 to 20% to fall in home prices, maybe more.
Percentage
and a lot
points.
Of percentage, yeah.
Percentage points, yeah.
In big markets, like California, Florida, probably in this area, the Northeast, we're going a lot lower than that. So we're years away from any kind of stability in home prices.
Pat, do you agree on that?
Less than years.
less than years. Baba Brown.
Well, one of the things, if you believe that today's market rally was in fact leveraged off the durable goods, whatever happened to the notion that it was the consumer that's the engine of our economy, that the consumer is two-thirds? This is a look at what some capital spending on the part of corporate America is doing. They're not affected by the credit crunch, the overwhelming part of our economy. I'd rather listen to what companies are saying now. We heard Darden Restaurants yesterday coming out and saying, guess what? There's no pickup in traffic. We have not seen people coming back.
Great point, Bob. That's the great point. When you get a company like Darden, which is a dominant force in the restaurant industry, and they had to lower their numbers big time, a lot of the other restaurant stocks went along for the ride, and it's indicative of what we're seeing in the economy right now. And if a Darden restaurant isn't, I don't know what is.
And Phil, you get the 1-2 punch with the high oil prices. Forget it. There goes the consumer.
If you look at the consumer side of the oil market, and that is gasoline demand, it is off the map. I see pain in those gas demand numbers. I see people changing their habits, and there's still more pain to come, I'm afraid.
Especially if Gustav does actually, push the prices higher.
That's right. And also, Phil, just a follow-up question quickly. Gazprom talking about an OPEC, a gas-type OPEC with Libya and Nigeria. Isn't that also a threat with gas prices?
It is, and you wouldn't believe how much natural gas they control. A huge amount. We talk about switching to natural gas in this country and its ample supply. To be honest with you, if you put those countries together, throw in Iran, they control 70% of the world's natural gas supply. This could be huge. That's why we have to think twice before we talk about T. Boone Pickens' plan to go to natural gas. We may just be exchanging one problem for another.
Right. Be careful what you wish for.
Yeah, it's true. There's always the balance on there. Thanks, gang. Here's a look at what's still ahead today.